So I will start with Seritage Growth Properties, SRG. One of my favorite stocks to cover, and I don't want to say it gets no love in the Motley Fool universe, but I feel like it's an underappreciated company. Brian, just let me ask you real quick. Are you familiar with Seritage?
Nope.
Okay. So if I were to pitch you this line, how excited would you be? Seritage was a real estate company that was specifically created to buy a bunch of old Sears buildings. Doesn't sound very exciting, does it? So, right. And that's why it's that's one of the big reasons it's underappreciated by a lot of investors. Seritage was specifically created in 2015 to buy a bunch of old Sears properties. I often joke that nobody wants to own a Sears building, and Seritage was created because even Sears didn't want to own a Sears building at that point. But the point is not to own Sears buildings. Seritage's business model is to own all these Sears buildings and gradually redevelop them into modern mixed-use premier retail and entertainment assets. The point is that when Sears were built, say in the 70s or 80s or whenever they were built, they were generally the premier shopping locations wherever they were. So a lot of these properties are in fantastic areas. I'm going to give you a few examples in just a minute. But there is a ton of value creation potential here. Seritage owns 183 Sears properties with about 28.5 million square feet of space. This is a pretty big portfolio. Only about 1/3 of that has been redeveloped so far. None of it is occupied by Sears. There were a few kind of Sears stragglers. There are some Sears in existence today, still, believe it or not. But none of them are in Seritage's property. So the only rent they collect is from that 1/3 of the portfolio that has been released. So of their properties, some of them they plan to sell, a few of them. They break their portfolio into three categories. They have their large-scale premier assets, which is where the most of their value creation potential is. And these have pretty much not been touched yet. Those are 31 of the properties that comprise almost 6 million square feet of space. So these are like large-scale, like picture like this, almost the size of like a full-scale mall that they can redevelop and create a lot of value. 130 of them are suburban retail assets, as they call them. This is where most of the redevelopment has been concentrated so far. For example, they might take an old Sears store and convert it into a Total Wine, a restaurant. I know Dave & Buster's is one of their tenants. Things like that. So kind of break it up into 3 or 4 different storefronts. They have 22 small market assets that they're planning to sell that are just kind of not core properties. And that's really how they fund their growth. Unlike most, it's a real estate investment trust. Unlike most real estate investment trusts, Seritage is not profitable. As I mentioned, only 1/3 of their portfolio is generating rent. I'm a landlord. If 1/3 of my portfolio is generating rent, I'm not making any money. So they need to sell properties to fund their redevelopment. They got absolutely crushed stock price wise during the pandemic. They're still trading for about half of what they were before the pandemic. The reason is there is a big liquidity question hanging over their heads. Seritage has one creditor. Their creditor is Berkshire Hathaway. Berkshire Hathaway financed a $1.6 billion term loan to get the business going. Warren Buffett is the biggest Seritage shareholder of their common stock personally, not Berkshire, in his personal stock portfolio. They also have a $400 million credit line from Berkshire that they can't tap into because they haven't redeveloped enough of their properties yet. So they need to get $200 million of non-Sears leases in place. They're at about 150 right now. So until they can do that, their only funding source is selling their other assets. So there's a lot of market worry about how long that could last, but the value creation potential here is just completely unappreciated. Seritage has a market cap of less than $1 billion. One large-scale redeveloped mixed-use property of Seritage's scale could be worth $1 billion if it's done correctly. Look at some of Simon's malls. Some of Simon's malls are valued at $3 or $4 billion. So a lot of value creation potential. And I mentioned they own about 28.5 million square feet of space. And I'm going to share my screen real quick, if I may. So here's an example of one of Seritage's properties. You can see the Sears building kind of right here in the middle. And they don't just own the Sears building. If you see this red line, They own all this land that's around it that is just sitting there as a parking lot space right now. And one of their core strategies is to add densification to their properties, meaning that turn half of this parking lot into a garage and the other half into a high-rise apartment building or something to that effect. They're building one of their properties is located in Alexandria right now. And let me see if I can you still see this okay?
Mhm.
This is in Alexandria, not far from Full HQ. And they just entered an agreement with Howard Hughes Corporation and a healthcare company to redevelop this whole big plot of land into a giant multi-billion-dollar mixed-use property. So they own this Sears building, which is big enough as it is. It's over 100,000 square feet all by itself. See the little outbuilding that's, I think, a Sears Auto Center out there. They own all this land. There's going to be a healthcare campus built here, some apartments, giant redevelopment opportunity. It's so just 28.5 million square feet of prime potential space. Sounds like a lot, but it's even more than that. There's all this acreage that they could redevelop and add densification. So that's the reason I am so excited about Seritage over the long run. It still trades at a massive discount. They really have some funding issues to work out, but if they can figure it out, there is a ton of potential here.